In this episode of Safe Money Retirement Radio, we'll discuss the differences between having plenty of money in retirement and having true wealth. Explore the options your beneficiaries will have after you're gone, and look inside a case file where a 52-year-old small business owner needed to set up a retirement plan for himself. Let's get started.
Is your retirement money safe? Really safe? Find out today on Safe Money Retirement Radio with your host, Tim Wood.
Hello, and welcome to another episode of Safe Money Retirement Radio. I'm your host, Tim Wood. This podcast and on-air show is dedicated to those of you who struggle with the fear of losing your retirement savings because of forces outside your control. There are ways you can still earn market-like returns without any risk and cut the fees you're paying to a broker, all while knowing your money is completely protected and safe. A Safe Money Retirement Plan has 3 parts: Medicare, life insurance, and a lifetime income plan. Once all 3 are in place, the stress levels can disappear because you can know for sure that your retirement funds are safe, you have the health coverage you need, and your family will be taken care of if and when a life event happens. Give me a call at 800-231-PLAN or visit safemoneyretirement.com for more details. And don't forget to visit safemoneyRetirementWebinars.com to watch recordings of any of my previous Safe Money Retirement webinars or register for any upcoming ones. Now, let's spend a few minutes discussing the differences in having a lot of money in retirement and having true wealth. So many people out there think having more money in the bank or in their retirement accounts will bring them peace of mind. But I work with retirees or soon-to-be retirees every day that have a huge nest egg set aside for retirement and are incredibly stressed. Many times even more so than those with smaller retirement accounts. Why? It's because having a lot of money and having true wealth are 2 totally different things. One of my main goals is to help people move from having money to having wealth. Now, let me explain what I mean. Having a lot of money comes with a lot of stress and worry about keeping that money safe. Is the market going to drop? Will I have enough in my retirement to last for my whole retirement? Will I be able to live like I want in retirement? Will I lose everything if I ever have to go into long-term care? The list goes on. And all of these stressors take their toll on a retiree's happiness and peace of mind. So what makes someone transition from having money to having wealth? Taking all of those stressors away so they can enjoy their retirement without worrying about the market or whether they will run out of money or live like they want. Now, how can you accomplish that, you may ask? Well, the single best way I've found to help people become truly wealthy is to get them into a safe money retirement product that will guarantee them that their retirement nest egg is completely protected from any market losses of any kind, while still allowing them to grow. These products are called fixed indexed annuities, and they can include a guaranteed income you and your spouse can never outlive, which means even if you lived a very long life and withdrew your account balance to 0 years before, you would still receive your guaranteed income payments for as long as you live. That's true wealth. These products can also focus on continuing to grow your nest egg by having it tied to a particular market index while at the same time completely removing the risk of a market drop. True wealth means you can sleep well every night knowing your lifelong savings are completely protected or that your income will never stop for as long as you live. That is what separates those with a lot of money that I see from those that I see that have true wealth. Peace of mind for the long haul. True wealth is priceless and what we all strive for, and I can help you find it. Just log on to safemoneyretirement.com right now or call me at 800-231-PLAN, and I will be happy to help you find your true wealth plan. And don't forget to register for your free copy of the Safe Money book while you're there. In this week's Noteworthy Retirement News, we'll look at what options your beneficiaries will have once you have passed on. Many retirees are very concerned about leaving a nice legacy for their families once they're gone, but few look at how that will work. The Secure Act of 2019 changed the rules for beneficiaries and how they can take distributions from your accounts. Now, before 2020, beneficiaries of inherited IRAs or other tax-deferred accounts such as 401ks, 403bs, TSPs, or anything like that could transfer the money into an account known as an inherited or stretch IRA account and take the withdrawals over their entire life expectancy. This enabled them to minimize withdrawals, which are taxed at ordinary income tax rates, and allow the untapped funds to grow. But the Secure Act of 2019, which SECURE is an acronym standing for the Setting Every Community Up for Retirement Enhancement Act, put an end to that tax-saving strategy. Now, most adult children and other non-spousal heirs who inherit an IRA on or after January 1st, 2020 have just two options. Take a lump sum or transfer the money to an inherited IRA that must be depleted within 10 years after the death of the original owner. Now, you need to know that this 10-year rule does not apply to surviving spouses. So if you got an inherited IRA from a spouse, this does not apply to you. Spouses can roll the money into their own IRA and allow the account to grow tax-deferred until they have to start taking required minimum distributions, which now start at age 72. Also keep in mind, if the IRA is a Roth, they don't have to take RMDs. Roth is on after-tax money. Alternatively, spouses can transfer the money into an inherited IRA and take distributions based on their life expectancy. It's their choice. The Secure Act also created exceptions for non-spouse beneficiaries who are minors, disabled, chronically ill, or less than 10 years younger than the original IRA owner. But IRA beneficiaries who aren't eligible for these exceptions could end up with a hefty tax bill, especially if that 10-year withdrawal period coincides with years in which they have a lot of other taxable income. The 10-year rule also applies to inherited Roth IRAs, but with an important difference. While you must still deplete the account in 10 years, the distributions are tax-free as long as the Roth was funded at least 5 years before the original owner died. Many heirs in this case simply cash out their parents' IRAs, but keep in mind, if you take out a lump sum from a traditional IRA, you'll owe taxes on the entire amount. And depending on the size of that account, that could kick you up into a much higher tax bracket, so watch for that. Transferring the money to an inherited IRA will allow you to spread out the tax bill by taking an annual distribution of a portion of the amount of the IRA. But because the new rules don't require annual distributions, you do have some flexibility. For example, if you're planning to retire in a couple of years and expect your tax bracket to drop, it may make sense to postpone taking withdrawals until you stop working. Still, another option is to wait until year 10 to withdraw the money, which would give you a decade of tax-deferred growth. On the downside, withdrawing all that money at once could trigger a bracket-breaking tax bill. If you choose to transfer the money to an inherited IRA, make sure the funds are rolled directly into your account. If you take the money as a check, the entire amount will be treated as a taxable distribution. Don't make this mistake. And however you divide up your withdrawals, make sure you empty your account by December 31st of the 10th year following the year of the original IRA owner's death to avoid that dreaded 50% tax penalty on what you should have withdrawn. Give me a call at 800-231-PLAN or visit me at safemoneyretirement.com for more details. In this week's case file, we're going to look at a 52-year-old small business owner who needed to set up a retirement plan that had 0 chances of losses and that he could add funds to when he had them available. After a thorough discussion, we determined a fixed indexed annuity with a flexible premium was a perfect fit for him. his retirement would be completely protected and still have a strong growth potential, and he could add to it when he had the funds to. I can help you find a plan as well. Just give me a call at 800-231-PLAN or visit safemoneyretirement.com right now, and don't forget to register for your free copy of the Safe Money book. For today's Full Chord, I want to sincerely and honestly thank all of the veterans that have served our great country, and leave you with two quotes. First, President John F. Kennedy said, "The cost of freedom is always high, but Americans have always paid it. And one path we shall never choose, and that is the path of surrender or submission." And President Theodore Roosevelt said, "A man who is good enough to shed his blood for his country is good enough to be given a square deal afterwards." Happy Veterans Day, and God bless you for everything that you've done for our country. Thanks for tuning in to this week's Safe Money Retirement Radio Show. Join me again next week to continue your free Safe Money Retirement education. Until then, keep it safe and visit safemoneyretirementradio.com. Take care.